This is a demonstration of problem 13-2B. Listed below are selected transactions of GN Furniture Store for the current year ending December 31st. The first one states on December 1st, the store purchased for cash 2 delivery trucks for $70,000. The trucks were purchased in a state that applies a 6% sales tax. So we would record the trucks at the amount we paid for them, including the sales tax. So 70,000 times 1.06 would equal $74,200, and that is what we would debit trucks for and credit cash for the same amount. The second transaction states that on December 10th, the store received $2,000 from the local community theater as a deposit to be returned after certain furniture to be used in a stage production was returned on January 10th. So when we receive money from a customer, we have to record a liability because we're going to have to return that deposit when they return the furniture. So to record this entry, we would debit cash for $2,000 and we would credit a liability account. In this case, I've named it due to customer. It could have different names. The third transaction states during December, cash and credit card sales totaled $524,000, which includes the 6% sales tax that must be remitted to the state by the 15th day of the following month. So the first thing we need to do is to determine what the amount of actual sales revenue was for these sales that we recorded that included the sales tax. So you take the gross amount, $524,000, and you divide it by 1.06, and that will give you the amount of the sales revenue, $494,340. Then to determine the sales tax liability, you take the gross amount, subtract the sales revenue, and that will give you the sales tax of $29,660. And of course these sales would have been recorded all during the month, but we're just going to make one entry. So we would debit cash for $524,000. We would credit sales revenue for $494,340. And we would credit sales tax payable for $29,660. The last entry states the store determined it will cost $78,000 to restore the area that's considered a land improvement surrounding one of its parking lots when the store is closed in 5 years. GN estimates the fair value of the obligation at December 31st is $61,500. So these land improvements that we've made to around the parking lot are going to have to be returned to their original state when the store is closed. So this is considered to be an asset retirement obligation. We do need to record that as both an asset and a liability, and we do that at the fair value, which the problem states is $61,500. So to record this, we would debit land improvements for $61,500, and we would credit asset retirement obligation for the same amount. And that is the conclusion of the demonstration for problem 13-2B.